Depending on the size of a property, commercial real estate can often be priced at $10 to $50 million or more. So unlike dollar cost averaging into something like an index fund or even buying a single family home to rent out, it can be really difficult to make these investments completely by yourself. This is why most commercial real estate deals are funded with multiple different capital sources, and these funding sources are what are referred to in this industry as the capital stack. And since this topic can get a little bit complex, in this video, what I want to do is break down how commercial real estate deals are typically funded, how each layer of the capital stack ends up working together, and some things that you'll need to consider if you are weighing different options to fund a real estate investment. So I think the simplest way to explain this is by using a sample deal scenario. So let's say an investor identifies a property that's a great deal, but between the purchase price and all costs associated with the transaction, the total acquisition cost would be $10 million. Let's also say that this investor is an individual with experience in commercial real estate and they know they can add value to the property, but they personally only have $100,000 in savings that they could use to put towards an investment. So in this scenario, if this investor wants to pursue this acquisition opportunity, the first thing that they're likely going to do is look for what's often the cheapest form of capital from an interest rate perspective, and this is senior debt. Senior debt refers to loan proceeds that are typically funded by a bank, insurance company, or agency lender that will usually make up anywhere from about 50 to 65% of the cost to acquire a property, and the senior portion of the term senior debt refers to this lender having payment priority over other investors in the deal. This means that the cash flow the property generates is first going to be used to pay any sort of monthly debt service associated with this loan, and if the investor can't pay monthly debt service and defaults, this senior lender could take back the property. This also means that when the property is sold, the lender is going to be owed their entire outstanding loan balance at that time before the equity investor takes home anything. And if for any reason the value of the property has decreased to the point where this is worth less than the value of the loan itself, that investor's equity position would be wiped out completely.